Hello, and welcome to this session. In our session, we're going to talk about a very important topic in management accounting and in financial accounting, and it's called mental accounting. And I'll explain what that is in a minute. But I'm going to present you with a scenario. Let's pretend you're going to a theater and you buy a ticket in advance and you lose that ticket. Would you pay another $10 to see the movie? That's scenario one. Scenario two, you don't buy the ticket in advance, but you lose the $10 before you get to the theater. Would you still buy a movie ticket? So scenario one, you lost the $10 ticket, and scenario two, you lost $10. Would you buy another ticket, or does it make a difference at all? Which would you prefer? So let's see what the research said. The research said that 46% of the study participants that lost the ticket would buy another ticket. But 88% of the subjects that lost the $10 would be willing to buy the ticket. Now, nothing changed here. In both cases, you lost $10. But our brains interpret information differently, allowing our brains to be manipulated. I'll talk a little bit more about that in a minute. So we got this crazy thing called mental accounting, and you're taking part in a neuroaccounting experiment where we think about cognition. But the thing about mental accounting is this. Brain operations involve the organization, evaluation, and tracking of financial information called mental accounting. So something's going on with our brain as we track information. The theory of mental accounting implies that as financial accounting systems, people assign labels to sources and uses of funds and tracks expenses within their mental accounting system. So I think that's interesting that our brains can actually track things and has a system going on called mental accounting. Okay, so here's some examples of mental accounting. The mental accounting framework suggests a system of preference of how investors view gains and losses. For example, when experiencing a gain of $10,000 or two gains of $5,000 each, people would prefer to see two gains of $5,000 over one gain of $10,000. So given our mental accounting, we would rather see two $5,000 gains than one $10,000 gain. They're the same, but our brain reacts differently. Alternatively, more people would prefer to see one loss of $10,000 over two losses of $5,000. So it's the opposite when it comes to a loss. We'd rather see one big loss than two smaller losses. That's what research shows us. Okay, in both cases, nothing's changed. It's just how our brain works. And I want you to be aware of this. This is so key. So there's some consequences to this thing called mental accounting. What are they? Managers may intentionally or unintentionally use mental accounting when presenting accounting information. People do it all the time. Oh, well, this loss looks kind of big, so let's move this thing here and have the loss kind of spread out over a couple of things. So these are things people do without thinking they're actually manipulating anything. For example, managers may massage their earnings numbers to show multiple small profits in different earnings reports instead of a big profit. Remember, we like seeing smaller profits rather than one big one, and multiple break even of small losses rather than a large one. So they may be manipulating things to present things in a certain way. Another example is taking a big bath, meaning, just taking a big loss in which management makes a bad year's results even look worse to enhance future earnings rather than breaking it up into small losses. So people would rather see one big loss than a bunch of smaller losses. So they'll just say, oh, this is a bad year. Let's just take everything now. Again, that's a manipulation. So other examples of mental accounting. Another example is on tax accounting. Taxpayers might put $998 on a tax return for a tax expense rather than $1,000, thinking that the odd number appears to be more realistic than the even number, thereby triggering a red flag. So what that's saying is, I've had taxpayers do it. I've prepared taxes, say, oh, I gave about 500 in contributions. Oh, but put in 478. Like, that's going to be more realistic. Okay, that's mental accounting, and the AICPA says that's unethical. Changing numbers to appear more realistic is not ethical for someone who's a CPA. So mental accounting and managerial accounting. You know, you're taking managerial accounting or you're taking cost accounting right now. What does this have to do with this? Well, in management accounting, there is evidence that mental accounting can explain the framing effects in interpreting variances. You may have had variance analysis already. Dr. Villano has mentioned it a few times, and you also should have seen my video about variances, okay? So maybe people would manipulate variances so they just don't jump out at you, per se. So when variances occurs, managers must make a decision of whether or not to investigate the favorable or unfavorable variances. Because of mental accounting, managers could frame variances in such a way to manipulate whether or not an investigation takes place. So again, managers they're not just overtly saying, oh, I'm doing something unethical. They're just saying, okay, I'm going to move these numbers around a little bit, so maybe they're noticed or they're not noticed, and try to manipulate how people respond to the numbers, because when it comes to mental accounting, we respond to numbers differently. So how do we overcome this? Okay, so this is why you're having this session, because I'm trying to help you overcome mental accounting tricks. All right? So we have a tendency to make decisions based on arbitrary mental categories. So our brain processes things in a simple way. And the value of the money does not change if we have two $5,000 variances instead of one $10,000 variance. It's the same thing. And that's what I'm trying to help you see, is that there's no differences here. Okay? It's a manipulation. Now, maybe those variances are correct, or maybe they've been manipulated so you don't look at something. We shall treat gains and losses as they are, trying not to set an arbitrary reference point or manipulate the aggregation levels. That's pretty sophisticated. The idea is, hey, let's not manipulate the numbers. So now we're going to look at mental accounting and variance analysis. When there are variances between the actual costs and budgeted costs, managers' personal evaluation is at stake. So if there's variances and you're a manager, someone's evaluating you. Managers must also decide whether or not to analyze the variances. So this is something else that's important. If there's variances, somebody may be looking at them. Using mental accounting tricks or biases, managers might present favorable and unfavorable variances in different ways. They might be moving things around to hide like a big variance, for example. And I said, for example, managers can break up one big favorable variance into two smaller favorable variances, or combine two smaller unfavorable variances into one big unfavorable variance. Like, remember, we'd rather see a couple of gains rather than one, but we'd rather see one big loss than some smaller ones. So there's opportunity for manipulation. So let's look at some numbers. Okay, so let's pretend this is what really happened. We have a 0 variance in direct labor, but we have a 200,000 favorable variance in direct materials. Now, that kind of stands out, right? If you're looking at this, I'm like, wow, we need to look into this. But if someone could manipulate the numbers and it looked like this, direct labor variance is 100,000, Direct material variance is 100,000. This will be less likely to raise red flags. And I talked about this a little bit in our earlier video on variances. Exactly, I talked about this, but I'm trying to get this through to you. That the variance is 200,000 favorable here, it's 200,000 favorable here, and don't be thrown by how these numbers are set up. Don't be distracted by that. These are the same things. It doesn't matter if it looks like this or it looks like this. This is a variance of 200,000 favorable. And here's the other example, unfavorable. Now, we'd rather have this than this. If we follow the theory of mental accounting, we're just taking a bath here. Like, okay, if we're going to have a loss, let's just go for it. But here we go. If we split it up, these things still are equal. A 200,000 unfavorable variance here, a 200,000 unfavorable variance here. And again, there's no difference in our total variance. So to reiterate, the purpose of this is to say to you, don't be distracted by manipulations that somebody might do to try to get you off track, to get you not to look at something by moving numbers around. Okay? So our minds are biologically triggered to notice certain differences. However, in management accounting, we need to be aware a variance is a variance. One more time, a variance is a variance. A large variance might represent an issue worth investigating, but also know that numbers can be manipulated to stand out or not stand out because of our biological reactions to seeing numbers. We don't want to be fooled by manipulations. A variance is a variance no matter how large or small. Okay? I hope you got the point of this presentation. Don't be fooled. Okay? Don't be fooled by looking at numbers, even though your brain will react a different way. We're just trying to get that through to you. I hope you understood this. I hope this is useful to you as for your practice, whether you become a CMA, CPA, accountant, business person, even marketing person. Not to be distracted by these variances and how people work numbers. Thanks a lot, and we'll see you in the lab.